G'day everyone, Max Wright here and making the first video in over 3 months. And in this video, I'm going to be showing you exactly which banks are going to collapse next. There are many more to come and they will not be FDIC insured. You will lose your money if your money is in that bank. So make sure you listen all the way to the end of this video. Now, I should address this fact. I should have communicated better. I apologize for that. But yes, I had a newborn child and just bonding with the child and family and helping mom and going on vacation, all the things. And, I kind of set you guys up perfectly for all of the things that have happened. If you recall, I gave you my exact portfolio. I told you the why I'm doing it. And I'm going to go back and recap this at the end of this video. But if you've done that, you should have been sleeping very easily through all of this tumultuousness over the last many months, and you should be doing just fine. So we'll recap that, see how it went, and we'll talk about those banks in just a minute. By the way, big shout out to Brett for taking care of the channel and providing content while I was gone. Really appreciate it. He'll still continue to do that, but we'll see more of him in a little bit, but I'll be making content as well. I'm hoping to get back into it, especially as there's so much more to talk about now. So let's go back and understand. I think we should start a little bit how the banking crisis that's been going on for about a week or so now. What is it? Exactly how is it working? What are the mechanics of it behind the scenes? And I'll just catch everybody up because I had a few people email me and say, Max, can you please come and explain things to me? Because you have a way of doing things, which I greatly appreciate that. That's why I do this. I think my way of explaining things are pretty good and help people who are not familiar with the technicalities of banking and all these kinds of things, help them understand exactly what's going on. So I'll go ahead and do that now. Okay. The banking crisis. Let's go back a little bit of time. We're going back, for most of the last 10 years, bank interest rates are zero or near zero. And then we get into the COVID years, and they actually do, in the United States, go to zero. 0 or 0.25, I think might have been the cash rate. But near zero cash rates, right? So this is the interest rates at the Fed. Now, if you're a bank in that environment, you have a duty. The way you get depositors to give you money, and then you go and invest that money somewhere, and you earn an interest. Hopefully more interest, you earn it more somewhere else than what you have to pay your customers to get your money, and that's how banks make money at a very simplistic level. I know there's way more to it than that, but for right now, that's what we're going to live with. Now, in that time, if the interest rates are zero and the market participants believe that an interest rate is going to have very low interest rates for a very long time, which is how we felt during 2020, 2021. Not so much me, but that's how the market felt. Then what happens is when the banks go to buy US treasuries or mortgage-backed securities that are guaranteed by the US bank, which by the way, they have no choice. If you are a chartered bank, you have to hold a certain amount of reserves in what the government says is AAA rated stuff, which is US treasuries, US government guaranteed mortgage-backed securities and other things, right? So the banks have to go and buy US treasuries. It's an absolute rule. They have to do that. They have to hold a certain amount on their balance sheet. You can get a little bit, they can even do things in other markets and borrow them and have them on their balance sheet, but someone has to have it. Banks have to have it, right? So you're in an environment where you are the interest rate on 6-month and 12-month US treasuries is like 0.25%, or sometimes even less. And you can't make money that way. But if you take maybe a 10-year treasury or a 20-year treasury, then that interest rate might be at 2, 3, 4%, something like that. And you can earn a little bit of money and you can make money as the banks do, right? So the banks were kind of forced to get into these long-dated treasuries, not short-term treasuries, but long-term dated treasuries. Still with not a particularly high yield, but there you go. So now the banks have got cashed up on these things. They're holding billions of dollars of these US treasuries in their things. So let's say, for example, they take a 20-year US treasury, right? And it's going to pay them 2.5%, okay? Well, now fast forward a couple of years and you find yourself now where the cash rate is 5% and 20-year US treasuries might be getting an interest rate of 4.5%, 5%, something like this, right? Now you've got these treasuries, and if you have to sell them, then you've got a problem because the government is every month they're selling US treasuries where the interest rate is like 4.5%, right? And you've got these treasuries over here where you for say 2.5%. Well, your treasuries are not that appealing. So what that means is people will not pay you full value. So the way a bond works is, let's say you give $1 billion to the US Treasury. They promise to pay you interest every single month and then give you your $1 billion back at the end of the 10 years, right? Well, so you've got this treasury, there's 18 years left to go. You put the $1 billion in, you get 2.5% every single month, right? And then you get the $1 billion back after 18 years. But there's the US Treasury selling 20-year ones at 4%. Well, guess what? The resale value of your bond at 2.5% is not that good. No one wants it because they can buy one right next door. It's dated a little bit longer, but not much, giving me 4% the whole time. And you're selling this thing with 2.5%. So the banks cannot sell those bonds for as much as what they bought them for. They spend $1 billion to buy them. They're guaranteed income. They're guaranteed return your money at the end. But if you have to sell them in the short term on the secondary market, people are not buying them. They might pay you 80 cents on the dollar, 85 cents on the dollar, that basically comes down so that the yield on that bond looks something closer to the longer term yield, if that makes sense. So the banks have got themselves into a trouble. They're holding all these things. The market expectation at the time, it was going to have low interest rates forever. Inflation comes along, interest rates get jacked up faster than ever in human history, and now all of these banks are holding these bonds that they cannot sell on the secondary market if they need to, and will probably have that problem for years and years to come because we're going to have this, Powell's been telling us, high interest rates until the job is done. We're going to keep high interest rates until blah, blah, blah. Okay, so here's the problem that banks get. What if this spooks depositors and there is a run on the bank, right? And depositors say, "Oh, I don't trust this. I want to get my money out." And if me and all the other depositors need to get our money out fast, under normal circumstances, the bank can sell its treasuries at pretty close to full market value, or maybe more, and give me my money back. But in an instance where the interest rates have gone up and the treasury is selling brand new treasuries with much higher yields, they're only selling these bonds for 80 cents on the dollar, 85 cents on the dollar. We got problems, big problems. The bank cannot service it. So this can be spooked. So this is what happened with SVB first. They got spooked. Now it's very, very interesting that this happened to a bank that is well known and for being a crypto-friendly bank. It services a lot of crypto companies and a lot of the crypto exchanges. When you wire your money to an exchange and from an exchange, you've only got about 4 options, and Signature Bank and Silicon Valley Bank were 2 of them, and then there was a third bank which they shut down. I'll get to that more in a minute. So I just want to bookmark this. I want you to pay attention. This is something that I'll address later in the video, but the major crypto rail banks happen to be the ones where the rumors started spreading and all of a sudden there was a run on the bank, right? We'll get to that, what that means later, but that's what happened. Rumors get started and there's a run on the bank. Now, what does a run on the bank look like? That's important to understand how runs on the bank have changed over the decades. Once upon a time, when there was a run on the bank, news spread slowly through radio and newspapers, right? And then people would rush on down to the bank. And the tellers were instructed to count the money out. So it's okay, everyone, we've got your money. We don't really have enough money. Count the money out really, really slowly so that when we close at 5, we didn't give everyone their money back from the whole big line. And that way we've got some days and weeks to keep everyone calm and try and solve the problem, get some money, borrow some money from somewhere, and find a way to make the people calm and go home. So it would take days and days. You'd go to the counter, and the counter would, the teller would count it. Okay, here's your money, sir. Let me just double check and count it. And bank runs were very, very slow. Well, now in the age of banking apps on your phone, this was the fastest bank run in history. Rumor spread, where it came from, we'll question that in a moment. Rumor spread that this bank was in trouble, and it was the fastest bank run in history. On your app, boom, boom, wire the money out, done, gone in hours. And people could do this en masse. So it was the fastest bank run in history. We haven't seen anything like it before because it happened so quickly. Within days, boom, just billions of dollars left this bank. Now, were they the only bank that could have been hit? Were they the only bank that had this problem? The answer is no. According to a report by the Federal Reserve last year, I think it was a Q4 report, 2022, over 300 banks around the country have this exact problem because it's a systemic problem across the entire banking industry, right? Everywhere. So, because all the banks are having this problem because they all did it, right? But for some reason, the rumor was started on these couple of banks. Okay. So, the run on this bank happens. So now what to do? Bitcoin, little side note here, Bitcoin did its job phenomenally. And we've seen it just be correlated with, the Dow Jones and S&P, and it's just been boring. It's been a highly correlated asset. And this time around, Bitcoin really, really performed. And it jumped up from, whatever it was, 24,000, I think, up to 28,000 during these weeks. Maybe it was 22 to 28. But it really, really did its job as people, because when there's problems with banks, see, people, when's the last time you've heard about a bank run? Like, the market forgets this stuff. And why do I care about third-party risk? I don't care about third-party risk. Banks are FDIC insured. There's a saying, safe as banks. And all of a sudden, the market forgets over decades. There hasn't been any bank runs. And the market forgets that you can lose your money. And so people don't worry about those kinds of things until it's time to worry about those things. And the amount of people plowing into Bitcoin to drive that price up was really, really good to see, that the market had been pre-educated. In the years prior, they had been pre-educated to know that Bitcoin is a store of value that has no counterparty. There's no third parties that can go bankrupt and you can lose your money, right? Same with gold. If you're holding the gold yourself, it's not being stored somewhere, it's not on your balance sheet, then you have that same with precious. You have the same with precious metals, and that's about it, right? You could do it with stock certificates, but again, you've got this issue where, what if you own stock certificates in a company that they're banking at one of the banks that went down, and the company just lost their cash reserves, right? So that's the still counterparty risk. Plus, there's the human beings of the CEOs and employees, etc. So Bitcoin and gold and silver and precious metals and commodities, for example, are very, very good in this environment when people remember, third-party risk, it's a thing that can happen. Okay, so now you understand how the crash happened. What did the Fed do to come in and stop it? Well, the answer is they said that in this particular case, we will allow the insolvent banks to sell us the treasuries at full value, not the 85 cents on the dollar discounted value. They will, I use the word sell, it's a bit loose. For 1 year, we will hold the treasuries at full value and we will give you full value money so that you can make your depositors whole. You don't have to liquidate your US treasuries at 85 cents on the dollar. And that, for the moment, has appeased the market. It has, it's like, okay, Silicon Valley Bank, they do have, their depositors are getting their money right now. And at present, I don't believe any particular people have lost money. Everyone has been made whole in this particular instance. And the Fed has said, we will give these guys a facility for 1 year so that they don't have to liquidate those bonds and they can make their depositors whole. And that's calmed the market for a period. They're still technically insolvent without this thing, but it's calmed the market and the run has stopped. Okay, let's examine that for a minute. Now, here's where I'm going to tell you that I believe the Fed is both the arsonist and the firefighter. They cause the problems, then they come in and solve the problems like they just did here, but it's a solving of the problem in a way that benefits them. Right? I'm going to cut over now to a very, very important question posed by a senator to Janet Yellen, and let's check out this little piece of information.
Let me start with some of the banking issues we're dealing with on it. Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVB just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is
And
your
we
plan?
made that determination.
Right. So what is
two
your
banks.
plan to keep large?
Hang on, let's just stop it there for a second. I want to draw your attention to something. She answered that in a way she thought where he was going was, well, if you're going to guarantee all the money for all the banks, you're going to have to print trillions and trillions and trillions, and we're going to go into hyperinflation. That's where I think she thought she was going. So what she did was she played it down. And she was like, well, we're only going to do this. And when the Fed board and the president and I think it's worthwhile to stop a really, really big problem, all right? But that's not where he was going. Here's where he was going, and it's extremely obvious to anyone who thinks about it for more than a minute.
To keep large depositors from moving their funds out of community banks into the big banks. We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
And just watch her fumbling and uselessness here. It's absolutely priceless.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening
And
because you're
it's-
fully insured no matter what the amount is if you're in a big bank. You're not fully insured if you're in a community bank.
Well, you're not fully insured. And
You
the big-
were at Signature, and
the
it
big-
just barely met that threshold. You were at Signature.
Well, we felt that there was a serious risk of contagion that could have brought down and triggered runs on many banks. And that's something, given that our judgment.
All right, blah, blah, blah. She starts fumbling over herself and it's embarrassing. So, but that is very much everything you need to know. And by the way, going back a few months, and I didn't bother looking for it, but if you happen to watch the channel regularly and you know which video it was in, please post a comment post a link in the comments. I'd love to see it. But going back a couple of months, I said, I think there was a guy, like a big YouTuber, millions of subscribers, could have been like a Meet Kevin or something like that, one of those guys. And he was like, guys, the banks are all insolvent, but the big banks are so much more insolvent than the little banks. Whatever you do, get your money out and put it in the small community banks. They're so much safer. And I made a video immediately, and I just was like, this clown has got absolutely no idea what he's talking about. Well, that is true. The smaller banks actually do take on less risk than the bigger banks typically, and they are better off, their balance sheet is better off than the bigger banks. That part is actually true. But to not know how things work is so, just got to be careful giving advice and listening to these people, right? Oh, it was blindingly obvious that the Fed works for the big banks. If you go back to the Great Depression, I believe I remember reading that they went from over 600 banks around the country at that time to, I think 5 years later, they were down to 60. A whole bunch went belly up, and the big ones came in and bought them all for pennies on the dollar, and you had a massive consolidation of power around the big banks. So she just informed you that the supermajority of the Federal Reserve Board, they need to okay these, effectively their bailouts for the banks. Now, who is on the board of the Federal Reserve? Well, you know it's a revolving door between the big banks. So former CEOs and former high-up managers of the big banks end up on the board. Then they go back and forth and back and forth. It's the same thing. It's a cartel. The Federal Reserve Board is not an independent body. These are the banking community. They're all tied to the bank. And the big banks, they wanted this. They want this because they get to come in, say, for your sake, if it's a big bank and if it's going to cause a run everywhere and the economy is going to crash, then we will step in and bail them out. They will not suffer the losses for their irresponsibility and for their risk-taking. The little banks, we're going to be capitalists then, right? Not socialists. We're going to be capitalists, and those ones, we're going to let them die. Small people are going to, and the small banks are going to die. We'll probably come in and buy them up for pennies on the dollar, grab their user base later if it's worth it. But otherwise, that bank has just been destroyed, and consolidation of power among the big banks happens. This is where they are both the arsonist and the firefighter, right? They wanted this. This is always what they do. Whenever they cause a crash, which they always did, they did this by this, the Fed caused this by the insane and very, very fast interest rate rise that they did, holding rates for zero for a long time. The laws are set up forcing banks to buy these treasuries at very, very low interest rates, jacking the interest rates up high. Every single bank in the country becomes insolvent. And now you get to sit around and pick winners and losers. The big boys, the ones who have friends and the ones who paid the money to get their boys sponsored onto the Fed board, they're going to be protected. Everyone else is going to be allowed to die. This is how the world works. And this is why I constantly teach people on this channel. Investing at this point, it's so sad, but the government has become so corrupt and so big and so gargantuan, and its partnership with big banks and big pharma and big industry is so corrupt and so broken now that to be a successful investor, you need 50% investment strategies and 50%, understanding the books and understanding the balance, understanding the rest, and 50% conspiracy theorist. Because you have to understand what's going to happen when the crisis is caused by the people. See, if you just know the economics of it, you'll say, this is going to happen in a few years because the Fed's going to cause it. And therefore, the smaller banks are probably safer than the bigger banks. So let's go and do something. Let's put our money there. And you will get crushed because you have to be a 50% conspiracy theorist to survive this. You have to know that the Fed planned this up front and then is going to rush in with the solution to get exactly what they want, which is a consolidation of the banking industry. There's been way too many competitors, way too many small banks enter the world over the last couple of decades, and they just want to get them all wiped out. So they'll let them die. Big banks will get rescued with bailouts, and they can consolidate their power. So it's unbelievably important that you understand this going forward. That's why I made that video 6 months ago, which is the safest place is not the little banks, which does have better balance sheets, which is less risky. It's not. The best place for your cash is in the big banks. Okay, so I hope that makes sense. I do, and I want to back that up with a little bit of evidence. So let me see here. Here we have, can you see that? It says, small US banks are borrowing in records to cover massive withdrawal requests and liquidations. Something will break soon. Good luck. And you can see here the massive spike we've got here in the little banks. You might not be able to see that, but this is borrowings from small domestically chartered commercial banks. This isn't last week. It just went vertical because people with a lot of money, we pay attention to what Yellen says. We pay attention. If you're FDIC insured, you don't have much money, you might not even notice this stuff. People with a lot of money, we notice this stuff. And they're like, oh, if my money's in Wells Fargo and they go bankrupt, the Fed's going to guarantee all of my amount. Good news. If it's over here in little bank, it's not going to be covered. I'm going to be uninsured. So what do? They are causing the run on banks that they are going to either rush in and save if it's a bank that's important, theirs, or they're going to let it die and buy it for pennies on the dollar if they want to, or just let it die. Either way, they consolidate their power. So that is happening right now. The title of this video is, these banks are going to fail soon. The answer is, it is the small banks. It doesn't matter. Don't put looking at their balance sheet to see if they're safe. That's got nothing to do with it. They're all insolvent all over the country. Every bank is completely broke, completely insolvent. It's all dead as a doornail. Some will be saved and some won't be, and it will depend if it's the big boys. And if it's the big boys, it's going to get saved. So I want you to know that. Okay, I'll go back to here because I'm not going to use charts anymore. What do I want to talk about next? I do want to wind up just quickly here with, I want to talk about the portfolio that I recommended a while back and why I've recommended it and how it's played out. You may recall I said you should really only have, in my opinion, you're never going to hear this from anyone else. There should only be 2 assets in your portfolio. That's it. 2. Cash and Bitcoin. That's it. That's all you need to sleep well at night. That's if you have an amount. So look, if you're young and you have like 10 grand to your name, it's like, whatever, put it all in something and swing for the fences. Like, put it all in Bitcoin and swing for the fences. That's fine. But if you are a person with a family and you have kids to look after and getting completely wiped out is not an option, they're the 2 assets that you need in your bank account. Okay? Because they manage, there's a lot of risks out there at the moment, and they're violent risks in different directions. So we could have, a massive stock market drop, recession, whatever. If the stock market gets clobbered, believe me, Bitcoin's going to get clobbered as well. And you want your cash around to scoop up those bargains, and you will be able to buy real estate, you'll be able to buy stock, you'll be able to buy Bitcoin for pennies on the dollar. But most importantly, you will be able to sleep at night during that whole process, because you're not having everything in Bitcoin and you're watching it go down 10% a day, right? That will give you the ability to sleep at night. If there is a recession or then a crash, which I think is quite likely, a big recession and a dropping of the stock market, I think is very, very likely, which will again, that'll be caused by the Fed with jacking up interest rates and all the things the government does, the fiscal policy, the monetary policy, all of it is an absolute disaster. So yes, these problems, it's going to happen. So the Fed is the arsonist, and then the Fed is going to come in and bail out the things that are important, the ones who are obedient, the companies that are in their favor. Others are going to get wiped out, and they'll be able to buy them up for pennies on the dollar, and they'll be able to consolidate their power in other industries too. That is absolutely a likely possible scenario, definitely a possible scenario. But this was the other scenario, so why you absolutely had to have Bitcoin, because this is another very, very possible scenario, and an absolutely inevitable one on a long enough time frame, I would say, is that you have a banking crisis. And if there is a banking crisis, then you have to have something without any counterparty risk. You have to have something that is global. You have to have something that you can take with you anywhere in the world. You can put a thumb drive in your hand, or you can remember a phrase in your head, jump on a plane, and you can be in a different jurisdiction where the whole banking system, worldwide economy has gone to shit, and you can have millions of dollars, which means when everyone else is, thirsty and hungry for getting resource, they're willing to sell their houses, they're willing to sell their investments, they're willing to sell their apartment buildings, they're willing to sell their gold, they're willing to sell everything. You can travel all around the world, find incredible bargains, and just start buying stuff up for pennies on the dollar. See, it's like the Fed is the arsonist, and then there's the firefighters who come out and help the people. Well, yeah, the firefighters come and help the people whose house is on fire. Well, you can be a firefighter by coming in and helping people whose house is on fire. They're going insolvent and they need to liquidate their assets quickly, and they will sell them for pennies on the dollar. You can be the firefighter, but what I choose to do is I'm the firefighter, but before the fire is lit, for months and months and months and months and years and years and years on my YouTube channel, I scream from the rooftops saying, guys, there's an arsonist there setting fire to the world, and if you don't do something, you can protect yourself, right? So my conscience is clear, and once the building is on fire, they need the firefighters. Like, you are of tremendous value to them to come in and buy their stuff up for pennies on the dollar, because the price goes from here down to here. And if you're the buyer there, then you get to help them out at this level. If you're not there, the banks will pick them up. The banks will buy their assets for here. You understand? So with a clear conscience, as long as you aren't cheering on, the destruction of society and cheering on these corrupt people and fighting the arsonists at every level like I am, with a very clear conscience, you can come in and be a firefighter and help these people out and buy their assets for pennies on the dollar. That is how it works. So I want everyone to be crystal clear on that. I know some people might be tempted to say, it's horrible to buy things for pennies on the dollar from people. If you don't, then someone else will buy it for less. So as long as you're not the arsonist, buying things for pennies on the dollar makes you a firefighter. So that's what I've been teaching here on the channel for many, many years, as you know. And so that's what I wanted to talk about there. So my recommendation for a portfolio is still exactly the same. All right, I think there's a lot more pain to come. I think we are going to see we're in this kind of consolidation period. I just yesterday I had a conversation with Dr. Where's his name? Dr. Jeff Booth. And it's an excellent interview. We go into this detail. We go into detail about what the next few months is going to look like. And I'm going to air that on this channel in the next day or two, so make sure you subscribe to that. And it'll help you understand what's going to happen to all the different assets. But the best and easiest way for an investor, not a trader. Traders are doing things and moving up and down. I get that. If you're an investor and you put things and just leave them there for years, your portfolio right now should be Bitcoin and cash. Everything else is not going to perform like those are going to perform, and not going to do a function like those are going to do. So I hope that's super helpful. Go ahead, hit the like button, hit the subscribe button, and I will see you soon.